Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and happy Sunday to you. Oh my gosh, we got to talk about an $80 million estate that might go bad. I'm talking everyone's beloved actor who didn't like Hoosiers and all the other movies, Gene Hackman. More on that to come because I don't want what's happening there to happen to your family. Part number 2. Boy, is it a recession? Is it a growth scare? What does it mean for your money? I got to make sure your 401k eventually turns into a 501k. Let's talk about some things that we can do to hedge so the 401 doesn't go to a 301 because you can't afford that when you're sprinting towards retirement. And again, the rest of the show, sincere and actionable ideas that are designed to help you do exactly what you want, which is get retired and stay retired. Connect with us online, getretiredstayretired.com. That's getretiredstayretired.com. Okay, first piece that we got to talk about is the theme of 2025. You've heard it for weeks, but it still bears fruit. 2025 is about pragmatic optimism. Now, that's a slogan. That's a saying, pragmatic optimism. It's meant to be a realistic dose of where we're at in the market cycle, where we're at in the economy. We also talk about an action item because it's all about IQ. It's not just intelligent quotient, it's implementation quotient. And one of the IQs, implementation quotients for all of 2025, we've called it week after week, diversifying your diversifiers. And I couldn't think of anybody better to help me break it down so you could get a similar disposition, but a different point of view of execution than one of our wealth advisors, David. David Bolanos, welcome to the studio. Thanks for coming in with us on a Sunday.
Thanks for having me. Crazy couple weeks that we've had and different information. Seems like it changes by the hour. So excited to talk about real strategies that everybody can implement in their portfolio as they look to be a good steward of capital.
All right, so let's go straight to stewardship because that resonates with listeners of this show. We know where that comes from. So David, if we want to be a good steward of our portfolio today, talk to us about what it means concisely and how we might be able to implement through VestGen Wealth Partners to help people diversify their diversifiers in 2025.
Yeah, well, I'll give you one stat to start with, and that's since January of 2022, there have only been 3 quarters where stocks and bonds have moved in different directions. So let that sink in just a little bit, because the old adage of investing is you have a 60-40 portfolio, and if your stocks go down, your bonds will go up. But if you heard it correctly, that's only happened 3 quarters since January of 2022. So something's got to give. And that's exactly what we're talking about is making sure your diversifiers are actually doing what they're supposed to do. And we're taking the training wheels off the market. I think the era of easy everything is probably over as we move forward through 2025, to steal a line from the economist Brian Westbury. We talked about in our outlook, and I think you probably talked about in the show, Craig, stocks are expensive coming into 2025. The market was probably waiting for something to come through to have a little bit of a sell-off, a correction, a washout. We have now had that, and now everybody's racing for ideas. So perhaps we talk about a few of those today. So this is not me saying that you should not own stocks and bonds, but I think what it is you should own stocks and bonds and probably something else. And I'll give you one super simple example, something that's been in a handful of our strategies the last several months is, we've had positions in gold. That's a very liquid, non-traditional investment that's been adding ballast to portfolios. We've also had broad-based commodity exposure through an ETF that's provided ballast through this most recent market sell-off. And ultimately, the way you figure out how to put those things in your portfolio is sit back and really think about this. You have all this money invested in all these different accounts. Where are you going to source your retirement income on day one of retirement? So if you're going to retire on June 30th of 2025, literally what investments are you going to liquidate to set up and start your monthly distributions? Because rule number one of retirement is don't sell stocks at depressed levels. That could be specific investments targeted, like some fixed income, some short-term treasuries, just to make sure that money is locked up safe. But man, if you're solely relying on just a bond fund, I think the last 3 years have proven that's probably not the best strategy. Because what if we start to see spreads widen, which is stockbroker talk for saying bonds kind of sell off? You might need to have something else.
So, David, let me pause there and say the following to you. So what I heard, if you're just joining us, we're talking about that thematic of pragmatic optimism, that theme of diversifying your diversifiers. That's how you implement with success in 2025. And David, what you said is if you're going to get retired and stay retired, you have to have things in your portfolio that are going to zig when other things zag. And ironically, for several years now, stocks and bonds, which is the traditional diversifier, are going the same direction with more frequency. So one of the things that we've been implementing in client portfolios that you said is a small bit of Tylenol, because Tylenol doesn't cure anything, but it definitely takes the edge off. You know, it can help you break a fever. It can be the difference maker when you need to get to the other side. And that means investing in precious metals. In addition to that, you talked about commodities. David, why might specifically precious metals and commodities make sense in today's environment?
Yeah, part of that's a currency play, right, on the strength of the dollar. But I'll give you another stat that's really interesting. Look at a chart of what Europe's doing with their reserves. Are they buying dollars or are they buying gold? The chart clearly shows that other countries have been loading up on that yellow metal. And so you have a lot of momentum going into that sector of the market. Look, there's lots of different ways to implement that stuff. And I think you make a good point, right? That's not your whole investment strategy. But to have something that zigs perhaps when everything else is zagging is something that everybody should be considering now, because it's not Armageddon right now. We had a correction. What you need to ensure is that you're prepared if this thing goes another leg down.
All right. So what I heard, David, is again, if you want to learn more, 833-964-PLAN. That's 833-964-PLAN. If you don't have your dose of Tylenol, you just might want to have some on hand. And making an intelligent allocation into precious metals, taking a look at an intelligent allocation to commodities also makes sense. David, talk to us about what it means to be in a global commodity super cycle, especially if we are going to see these foreign nations start eliminating spending caps on their GDP because they're about to start bolstering their defense. You know what that screams to me? Commodities of all forms, steel, fossil fuels, liquefied natural gas, you name it, the prices are down, which means the rebound based on demand and consumption could drive those prices up. Talk about how you make some allocations to commodities for clients who want to diversify away from just stocks and bonds.
Yeah. So I mentioned the most liquid way to do it, which is through an ETF. But there's plenty of other ways to play that. One of the big themes we talk about is global infrastructure. There is a race to build energy throughout the globe right now. And we've been concentrating here on kind of drill, baby, drill. And in other places, they're still gung-ho on clean energy. And there's a race to build that infrastructure, and they need commodities in places like Africa, right? It's a race between Europe, China, and now we're trying to get in that game too. So there's lots of different ways to play it. But that infrastructure theme, we run that through a BDC, very similar to some of the private equity and private debt strategies that you've talked about on the show. And I think all of those strategies have one thing in common. Once you've made it in retirement, your only job is to hold on to it with two hands. So when we talk about these non-traditional investments, the way I think about them with the families that we're working with is these are not investments to get people wealthy. These are investments to keep people wealthy. Perhaps they have better risk-adjusted returns than certain stock markets over market cycles. But when we sprinkle these in as satellite positions, what they're trying to do, again, is provide that zig when other things zag. Typically, those investment strategies will probably underperform in a raging bull market, but historically, they have outperformed in sideways or down markets. So I would encourage everybody out there, what is your personal view on the market moving forward? We'll spend a lot of time talking about our view on the market, but what's your view? Do you think that we're set up for another double-digit return? And if you say, you know what, I don't think that we're maybe set up for a double-digit return, then what would be wrong with sitting down with a firm that's been running alternative strategies since 2005 with success in client portfolios and hearing how they might benefit you? And I think that's the key, right? When we talk about all of these non-traditional investments, you start to hear in the industry, everybody else is starting to pick up on that. But my suggestion for everybody on Main Street is work with someone that actually has been doing it for a long time, that's running more than $1 billion in those strategies, because they actually understand how they work and how to implement the real stuff.
833-964-PLAN. That's 833-964-PLAN. Let us help you get strategies that are TNT, tested in the trenches, so you too can diversify your diversifiers, because everybody deserves what we all want, which is a sleep at night portfolio. Okay, more to come. You got to learn and have a plan on where your first dollar is going to come from when it is about retirement. We're talking that right after we pay some bills. Quick commercial break. AM 560, The Answer.
Radio with Craig Balanas on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
Oh my gosh, you know who's getting pummeled? Gene Hackman's estate. That thing's an absolute nightmare. We're going to talk about that in a bit, because I got some takeaways that you can learn from an $80 million estate that might be going wrong. But right now, it's all about getting retired and staying retired. And one of our very best wealth advisors, David, is joining us in the studio. And David, that was some great information. I love what we talked about in that first segment, diversifying your diversifiers in a year of pragmatic optimism. That's diversifying your diversifiers in a year of pragmatic optimism. But David, you said in your tease, you got to know where the first dollar comes from in retirement. What does that mean to you, a practitioner who is helping families across 41 states secure their wealth?
Yeah, well, I mean, we can talk about investment strategies until we're blue in the face, but at the end of the day, retirement is about dollars in versus dollars out. It's all about cash flow. And all of these investments might be great investments standalone, but they've got to work in the plan. There has to be, it's like what I call a liquidation order for your accounts. So, if we're working with a couple, whose IRAs are we touching first? Are we using trust money first or second? Some of these investments generate income. Do we want the income to show up on your 1040 or tax return, or do we want to defer that in your IRA? So I think that the way that it needs to be approached is we got to figure out what that distribution plan is going to look like. And then we reverse engineer how the dollars come out of these accounts. So I would encourage everybody to start with the end in mind. There's two ways to do financial planning today. You can run lots of models and stress test whether or not you have enough money. And I think that's an exercise that everybody should be going through every 24 months. But there's also what I call the whiteboard, which is, okay, we know we have enough money, but literally, how do we take these portfolios apart? Because again, if we're keeping it simple and you're using some algorithm and it's just going to sell every investment every month when you need money, that certainly works in an up market. But do you want to sell your shares of NVIDIA to meet your monthly distribution when they're down 15% for the year? Probably not. So, Craig, I mean, I know you kind of view all this stuff the same way. Expand a little bit on how we actually do that at VestGen.
Well, yeah, David, you're talking about an income plan. And I want to make sure I make a very important distinction because there are lots of people. I'm an AM radio junkie. Radio is not dead. Talk radio is not dead. It's great. But so many people on other shows in the media, they talk about these income plans. But you know what their income plan is, David? Their income plan is we're going to put some of this money into an annuity, and that's your income plan. No, what you are talking about, David, very specifically is managing for the footprint of taxes and having a tax budget. Because going into retirement, you need to put yourself into a position to be tax diversified. You need to work with advisors who understand how to create a blend of various passive income streams from your taxable, tax deferred, and tax-free assets to engineer a defined outcome on your tax return. That's really what you were hinting to, right, David?
100%. And, to me, it's year by year. So year one of retirement through year 10, show me year by year where the money's actually going to come from in my portfolio, because you will have natural things that are going to occur, turning on Social Security, maybe receiving a pension. All of those different events set you up for things like, maybe I can do some Roth conversions in these years, but I have to take a break in these years. And I got to be careful because I'm hopping onto Medicare and I don't want to pay IRMA surtaxes. So if you're not working with a firm that can go into that level of detail, I will just say you're skating by. But everything that we talk about at VestGen is doing things not just to be okay or just to be good. It's to do things in the optimal manner. And the way that you do that is you have conversations, you create a dialogue, and then you build this and then you modify it over time, because life is dynamic and nothing that you outline is ever going to be exactly the same. You've got to be flexible with these strategies. And to your point, it's an investment thing. It's also a tax thing. And if you can't combine those two things together, you're okay, but you probably aren't optimal.
So, David, I have to pick up on something because we need to end the madness. And the madness that I'm talking about is there are so many people who have diversified portfolios of mutual funds, people who have diversified portfolios of index funds, people who have over-diversified portfolios. But you know what we see time and time again is advisors who have gotten lazy because they're an advisor who's a solo advisor with maybe a receptionist or an assistant, and hence they put the retirement withdrawals on automated pilot. And if you have the type of portfolio that it's diversified, 60% in stock, 40% in bonds, 70% in stock, 30% in bonds, and you're taking a withdrawal from that blended account each and every month, you heard what David said. You're setting yourself up for failure. David, be very specific why advisors who have blended portfolios and put automated distributions from blended portfolios each month, why it sets clients up for failure.
Yeah, because in a bull market, in an upward trending market, you are selling assets at appreciating prices, which works up until we have that bear market where now you are selling all of the equity portions of your portfolio at the exact same time. And you might be selling, assets that are down 10, 15, 20%. You don't want to sell those. The reason it's set up that way is it's the easiest way for the advisory firm to do it. So my suggestion is find a team that you can work with, because that team has not just advisors, but behind the scenes, they have traders like ours. They have people that can ladder out the fixed income like ours. And if you do that and you control the downside, what I know is over time, the upside tends to take care of itself.
David, that's so incredibly important because, again, if you have a 60-40 portfolio, 60% in stock, 40% in bonds, and you have a systematic monthly retirement distribution from that, well, guess what? In the month of March, you just sold 60 cents of every dollar worth of stock at market lows. And if you do that consistently in a bear market, which we're not in, but eventually one will come at some point during your retirement, how is your money ever going to recover? It's not. 833-964-PLAN. That's 833-964-PLAN. Get retired, stay retired.com. It's important to evolve into a higher level of care. David, one of the reasons that other advisors aren't buying individual treasuries that mature in clients' accounts. One of the reasons, David, other advisors aren't simply laddering bullet shares in clients' account is why. Pull back the curtain and reveal what happens and tell them how VestGen is different.
Two reasons: time and intellectual capital. So the first is, if you are a solo practitioner or you're working with an advisor, it's just him and his sales assistant, and you're meeting with that advisor during the day, who actually implements the transactions in your account? Think about that. There's only two options. Either someone's doing it at night, or there's some type of computer program, some algorithm doing it that has no idea who you are. So if you want a team that has actual execution at the right times of the day, you're going to have to work with a team that has probably not one, but several traders, and also, I'd argue, several trading desks. The reason that VestGen exists is to create a multi-custodial platform with multiple research departments and multiple trade desks to get best execution. So the traders have one job. Their job is to sit in front of the computer and not trade stocks or bonds, but to be able to execute in portfolios when necessary. If I'm a solo practitioner, I can't go out and create a bond ladder for every client. I won't be able to keep track of it. But if there's several people that are working on that, they can do that behind the scenes when the advisor is sitting with you, going through your cash flow plan. And as the markets become more dynamic and they move quicker, I think that's going to be so important. I mean, think of how quickly markets move. Last year, we had, 3 stock market corrections. We had one in the spring, one in August, one in December. They were very sharp moves down, and luckily they were very sharp moves higher. But what if they didn't just come back higher? How quickly can your advisor execute? Well, if there's only 2 people working there, I would argue it's going to be pretty darn slow. That model of service is going by the wayside. The new model of service is to have redundancy after redundancy. Have people that worked on trading floors and then have a backup to that person and a backup to the backup is what we have built out over the last several years. And that's building that out because that, I believe, that is the future of wealth management moving forward.
David, it's not just your belief, it is my belief, it is our collective belief that it takes a team of multidisciplined specialists all working under one roof for one purpose: to help you get retired and stay retired. You want to learn more, you can, you should. 833-964-PLAN, 833-964-PLAN. Visit our website, getretiredstayretired.com. That's getretiredstayretired.com. If you like our messaging, you've been listening a long time, ask and request to sit down directly with David. Ask and request to sit down directly with myself, Craig Bolanos, and we'll help put you through that journey that other families have gone through so you too can sleep at night. More to come in the know. AM 560, The Answer.
Want more in the know radio? You can't handle more in the know radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
833-964-PLAN, 833-964-PLAN. So Gene Hackman, one of the greatest actors of all time. I mean, listen, an impressive career. I mean, gosh, an impressive life as well. I mean, a long life at that many people would probably only dream of. The issue is it's making it around. I actually saw this in People magazine of all places while I'm in line at the food store because no, I don't do self-checkout. I like to have a cashier. I only do self-checkout if I got one item. I don't do self-checkout with 100 items in my cart. I don't know why people do that. They jam it up. But at any rate, here's my point. When Gene Hackman passed away, his wife, Betsy, had died before him. right? And I'll bet you that Gene Hackman didn't anticipate, nor did Gene Hackman's attorney anticipate, that his significantly younger wife, 65 years old, would die before him, 30 years her elder, Gene Hackman. And as a result, we've got an estate plan that is now up in arms in contest because we didn't use a set of checks and balances. We didn't use a set of belt and suspenders approach. Now, you don't have to have 80 million. You can have 80,000. You can have 800,000. I don't care what you have. You need to make sure that you have a series of checks and balances in your plan, because remember, you always expect the unexpected. That's not just an investment thing. It's not just a tax thing. It's an estate thing. You got to expect the unexpected. So here, what do we know so far? Gene Hackman's will was drafted in 1995. We know it was updated then at a future state in 2005, of course, naming his wife of more than 30 years, Betsy, as the sole beneficiary. What do we know? She had a will too. And guess what? Her will named him, Gene Hackman, as the beneficiary, but it also included a clause that if they passed away within 90 days of each other, her estate goes into a trust and potentially gets donated to charity post-medical expenses. Well, wait a second. See, this is bad because she died first. And Gene Hackman's money, right? Where I'm going with this whole thing is, was the money supposed to go to Gene Hackman's 3 kids? Is all this money accidentally going to charity now? Listen, if you have people that you love and you love them back, then you need to read your estate documents extremely carefully. And you need to be working with advisors, professional estate attorneys, and advisors who are going to have a series of and or clauses. If this and that. If that happens or this happens, then such, because you got to role play it out. I ask you, are you married? Do you have a best friend in life? Is it your wife? Who's more stubborn? I say that to people all the time. Why? Because if you're in some form of a mutual accident, mutual disaster, the person who is stubborn is going to survive. That person who is stubborn isn't going to go gracefully into, an angel overnight. They might linger. And what can happen is if you're married, then all of your money moves into your spouse's estate. They hang out, intubated, on life support 30, 60, 90 days later. Now everything remains in their estate. And God forbid this is a second marriage, or God forbid you had different intentions. You could inadvertently completely disinherit your entire family tree. That's what we're talking about here. And we're at a spot now where I think for Gene Hackman's 3 kids of a prior marriage, what are they doing? Instead of mourning their dad, instead of mourning his wife, guess what? They're all lawyering up and trying to figure out how everything's going to get distributed, because there could be an accidental disinheritance in place. Now, you might think that the Hackman family would have access to tremendous attorneys and talent. Well, of course they should. You know what? I think the great comedian Robin Williams should have had access to the same stuff. I think the great talented actor Philip Seymour Hoffman should have had access too. I think that album, Purple Rain, Prince, his state was jacked up too. It's not that hard, everybody. So here's my call to action for you right now. If you have people that you love and you haven't taken the time to really look at your will, your pour over will, your testamentary trust, your revocable living trust, you haven't looked at providing credit shelters to save on estate taxes, you haven't taken a look at digital asset provisions for your digital footprint, you haven't gone through disaster provisions just in case there is a common disaster, natural disaster, act of war that claims the life of you and your loved ones at the same time, then you too could be chock full of unintended consequences and accidental disinheritance, and we can't let that happen. I want you to give us a call at 833-964-PLAN, 833-964-PLAN, and let us do a complimentary review and complimentary flow chart of your family's existing estate plan. Because when we create the visual and create the flow chart, then we can start scenario playing, or as David in our office and Jason, the attorney, calls it, whiteboarding. Because wouldn't it be ideal that if this happens or that happens, even if it's a low probability of occurrence, you can ensure that your documents still work effectively? That's the benefit. So connect with us today. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. And let's take a learning lesson about what just happened with the Hackman estate to make sure it doesn't happen to you. And my takeaways, again, very specifically, always name alternate heirs. So-called mirror wills, living wills between life partners, between spouses, they're a good practice, but you really need to make sure you go and name alternate heirs with a succession. You got to review the documents regularly. That's my point. You have to have specific beneficiaries, specific trusts named. Do not let simple intestate succession apply. You don't want that, because you don't want the state that you reside in having an influence on where the monies go. Special clauses, they get so many people in trouble. Again, special clauses get so many people in trouble, like this clause in the Hackman estate of money going to charity after medical bills if the spouses died within 90 days of each other. I mean, didn't someone think that they could have been a car accident together? Didn't someone think that something could happen? Yes. And you need to make sure that you have your stuff well documented and reviewed. I'm giving you the pathway to do that for free today. Let us provide you a complimentary estate diagram, a flow chart, if you would, on how your monies, your wealth, your executors, agents, your successor trustees are going to play out. And when you have that visual, then and only then can we start having good conversations about what if this low probability event happens, what if that low probability event occurs, so you can make sure you feel secure in the lifetime of treasure that you have worked, because your estate plan is not just about giving monies to the ones we love. Our estate plans are about putting the ones we love in a position to be successful. That's the mitigation and elimination of probate. That's the mitigation or elimination, if possible, of estate taxation. That's tax efficient inheritance for withdrawals. That's having the right assets in the right type of accounts. It's also about advocacy. It's making sure that if you don't die, but you get sick or injured, that there's effective covenants for financial institution transactions, not just healthcare, to keep your life rolling and protecting your choice. 833-964-PLAN. Go out to our website, GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. All right, more with VestGen Wealth Partners in the know, AM 560, The Answer.
Knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
We've got to give everybody a geography lesson, and the geography lesson I'm talking about is I don't know, but the trend is starting to emerge. It's not negative, because we're going to get in front of this trend and we're going to ride this trend if it turns out to be secular long term. But our policy, America First, good policies, they're having some unintended consequences of actually making the rest of the world outside the US attractive to investors. I know that sounds weird, but yes, our America First policies are having the unintended consequence of making the rest of the world attractive to investors. And what am I talking about in 2025? Well, in case you don't know it, international stocks outside the US are performing in a way that I haven't seen I haven't seen in some 14, 15 years. You got emerging markets. You got developed markets. They're all up solid single to low double digits on the year. And on the other hand, everybody knows that the U.S. markets, we're kind of on the struggle bus on a year-to-date basis. Now, much of the interest in international equities has come as a result of the recent turmoil in the stocks. And it's not tied to the tariffs. Again, the tariffs aren't the issue. I want to say that. The tariffs aren't the issue. It's just the chaos of how the media is helping this unfold in a very public setting. But if you look at what's happening in some of these other countries, like in developed markets like Germany, when they eliminate spending caps for their country relative to GDP because they want to ratchet up defense spending, that's code word for stimulus. That's code word for printing money. And when you inject stimulus, when you inject money into the system, it has a tendency to grow. Look at our markets. We had all of this stimulus courtesy of the Tax Cut and Jobs Act in 2018. That was so stimulating to the U.S. economy, stimulating to the U.S. taxpayer, stimulating to U.S. businesses. It's a very, very big deal. And weren't investing during that time period of 2018, 2019, early 2020. It was great. Then in the U.S., rightly or wrongly, COVID came. We printed a ton of money, did big stimulus packages, and this party kept on going in 2021, took a sabbatical in 22, and then we had continued growth in 23 and 24. So what I want to talk about here is the simple fact that we have something that's ironic, and I want to make sure investors don't get caught off sides. U.S. markets have been the place to be since May of 2010 through December of 2024. Let me say that again. U.S. markets have been the place to invest from the spring of 2010 all the way through year-end 2024. That's a 14-year run. That is a long-term secular trend. That is why good money managers have had very large overweights to the U.S. That's where we've been. Now, though, it's only been 2 months and 20-some days. But in the 2 months and 20-some days of this year, I say to you again, there's all of a sudden global interest in developed markets, global interest in emerging markets, and that is not a vote against the United States of America. Our economy still looks good. It is a simple fact that in a lot of these European nations, they know that they need to increase their defense spending. And as a result, for those countries that have had caps on their debt relative to their GDP, they're temporarily suspending them. And if you follow the trail of stimulus and you follow the trail of money, getting dollars invested overseas might just be a sample of diversifying your diversifiers, which we talked about earlier in the show, that you need to continue to drive performance. So I do think that international markets have the potential to really continue to drive returns in the months and years ahead if we continue to see other nations in the Euro and EM do something similar. So if you want to learn more about how to invest in American depository receipts, those are foreign stocks that trade on U.S. stock exchanges. You want to understand how to invest properly in local shares. You want to make sure that you understand how the strength or temporary decline in the US dollar is going to affect those foreign investments. Well, we can help. We can help. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. And remember, it was just 90 days ago that investors kind of thought that President Trump would make a bad situation in Europe or a bad situation in China economically even worse. But now where we sit, Trump's policies have caused those countries to enter down a path of printing money and doing stimulus. It's still early, but if that's a sustainable trend, that is an investable trend that you deserve to make sure you're a part of, and we're helping our clients align and definitely get there. 833-964-PLAN, GetRetiredStayRetired.com. Now, make no mistake. We don't think there's going to be a recession in the United States of America. Make no mistake. We think that this is a correction created from the way the trade narrative has unfolded publicly, just the chaos relative to how it's unfolded publicly. But I do believe that it's important in this view of pragmatic optimism for 2025 that we are diversifying our diversifiers. And we talked earlier today about precious metals and how they have a place. We talked a little bit today about how commodities and long-term commodity super cycles, especially with increased defense spending around the globe, are going to be in play. We've talked in previous weeks about participating not just in public markets, but participating in private markets. That's the world of private credit and real estate for passive income. In addition to that, we've talked about everything you should want to know, everything you need to know about digital currency markets, given the change in this administration, the change in taxation, the change in regulation, the fact that there's money moving into digital currency, which is cryptocurrency. And it's not for everybody, but for those who want to diversify their diversifiers, it's one additional arrow in the quiver that small allocations may have a meaningful place to. And the reason I go into all this detail is if you want to be successful, you can't be static. You can't settle. You need to seek for constant improvement, because the hallmarks of a great advisory firm are preparedness and flexibility. I repeat, preparedness and flexibility. We spend so much of our time helping our clients future-proof their retirement. That's what it's about, future-proofing retirement, because there are so many risks that can be addressed. And if you want to learn more, you absolutely can. You absolutely should. I encourage you to work with advisors who are like-minded, advisors who may see the world from a similar point of view when it comes to individual freedoms, free markets, etc. That's us. We're a family office. We are multidisciplined professionals. It's the investment advice under the fiduciary standard, the financial planning, the cash flow models under the CFP standard of care. It's the income taxes. It's the estate planning. We talked about what it means for the Hackman estate, which may have some $80 million unintended consequences of disinheritance because their documents weren't fresh. If you're looking for a new way, what could be a better way, you want to be with a firm that brings it all together, connect with me, Craig Bolanos, VestGen Wealth Partners, GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. All right, more to come. You're listening to In the Know on AM 560, The Answer.
Get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
So in case you missed it, we had a Federal Reserve meeting, and what did their decision, what was their testimony about? Well, they provided a slightly dovish, that's good surprise. They offered investors some reason for optimism, although it's not enough optimism right now to offset the headwinds that are still hitting stocks, primarily trade and tariff talk. But what I want people to really think about, if we look at the market vernacular, the Fed's decision this week and their rhetoric reminded everybody that markets can still rely on the Fed put. It's still alive. They're still ready to use it. They will act as a backstop, and that's good. But ultimately, remember, there's not going to be a V-shaped bounce from the move that happened in the last 3 weeks up until a very clear and consistent goal is communicated to markets over the end place of where we expect tariffs to be and trade. Number two, we need to make sure we get some consistently reassuring data that economic growth is not fading, because we know that consumers feel bad. All the surveys are telling us that, but consumers haven't changed their spend. We just need to make sure those bad feelings don't turn into a slowdown of consumer spending in the weeks and months to come. So from a positioning standpoint, that is the reason we talk about pragmatic optimism for 2025. That is the reason I want you who listens to this show to diversify your diversifiers. We touched again on precious metals, on commodities, on private investment strategies to generate passive income in the form of private credit, secured, anchored real estate, and of course, talking about geography. You can't just have a U.S. view. You have to have a global view. And if foreign countries are going to be removing their spending caps relative to GDP and printing money, that smells like stimulus to me, might be an investable theme on the other side of the pond, even though U.S. will, of course, remain your overweight position. But if you want to learn more about what we do, you want to experience that multifamily office difference, I encourage you to connect with me and our team online. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Or pick up the phone and give me a call, 833-964-PLAN, 833-964-PLAN. For everybody out there, I hope your NCAA bracket is successful. For everybody out there, I hope you have a very blessed week. God bless America. God bless our country. And let us help you and your family get retired and stay retired.